The Fed is going to meet later this month to decide on whether or not to keep cutting rates. But the tariffs in China may change everything.
Yeah, so here we are again.
And we're off. We're
I
on,
know,
we're
I
off.
know. It's interesting. I was in Mexico City over the weekend,
Oh.
and they're actually talking about this too, right?
Mhm.
Because it's very, very different, obviously, down there when you're reading the news about what's going on there versus China. Also, very, very similar conversation they're having as well. So the real question, I know we're going to dig into all this, is you know are tariffs going to be inflationary? Because if they are, it's gonna seriously impact real estate.
Yeah, and people, I think that there's just this disconnect. People look at the tariffs impacting the stuff they're buying off Amazon, like the clothes and things from China. But realistically, this goes into building material, building cost, which also can affect mortgage rates depending on the inflation. So there's a lot that this has to do with real estate.
Yeah, and I know obviously this is a super controversial topic. Trump is not moving from his position. I can assure you that. He wants to protect American industries, and he believes strongly that this is going to bring back jobs. Whether we believe it or not, that's his view. So this is just he's doubling down here, and the reality is if imports cost more, then the tendency would be for us to buy local or stay in the U.S. So now the question is everybody's saying it's not going to create inflation, and there's even some concern on whether or not it will really bring jobs. Now, that is, I know personally plenty of companies that are now moving their manufacturing back here and hiring. So now that's a very, very small sampling, and certainly not reflective of the whole economy. But I do know that is definitely happening. I have a lot of friends that used to outsource things, and they manufacture elsewhere because it could be done so much cheaper, and then they sell it in the U.S. So, it has created jobs in those particular examples.
But the question would be, is it going to affect their prices? And I think, some of our friends that we have that are moving over are not fully moved over yet. So it will be interesting when they do, if it affects their prices.
I definitely think it will. I mean, it has to. In the conversation I've had, it's a heck of a point, because that's always the next question, right? What does it do to your margins?
Right.
So there's a couple things. One, don't forget the business, whatever it is, has a margin, right? So I don't know, 20, 30, 40%, let's just say. So if something they're getting from China was $500, and then 20% of that makes it, let's say, 600. That's their margin. So they're definitely getting squeezed on their margins. On the other side of that, they have to decide, can they push, something that was 500 out to 600? Can they do that? If they bring it into the U.S., maybe it's 700, right? And so, those are the things that they're wrapping their heads around. If they still want to be in business, they can't just have a massive price increase to the consumer, because the consumer ultimately decides whether they're going to buy something. So, that's the big pickle that they're in. And I think, they're scrambling, obviously, to try to figure out how to make it work.
So the Fed's main mandate is to control inflation and unemployment, right? And they've been balancing that, and they've been focusing on inflation the past few years. And then now they had started to lower rates because they're starting to focus on the job market. And that was kind of expected, throughout the end of the year. But now with these tariffs on China being implemented, the Fed's really going to have to consider what they want to do at the end of October. It's really now they're the ones that have this big decision on what to focus on.
Well, that's right. And so let's just look at the data, because I think that's really, really important in everything that we talk about. So we know that the Fed's target goal is 2%. There's a lot of people that think that that's too low. But what is interesting is, obviously, if you're saving money, that's an important number, because that means that 2% a year over 10 years, it's a 20% loss in the purchasing power of your savings. So the Fed is sitting at 2. Now, there's some people that say that it should be higher. And then there's what a lot of people are starting to call the neutral rate. So what's the neutral rate? The neutral rate is what is the number? What is the inflationary number where there's neither inflation or deflation, right? It's kind of that neutral. Now, it's obviously more complicated than that, but you kind of get the point. So in other words, when the government's not, when the economy's not pushing up or pulling back, right? And so the question is what is the real number? Is the Fed going to move the needle? Are they going to push that up? But inflation went from 2.7 to 2.9. We know that, right? Now, that's not very much, but it did go the wrong way. And also, there's the unemployment rate that is kind of out there on the horizon as well. Now, if this works, if people are going to manufacture more in the U.S., then you're going to have onboarding of jobs as well to kind of offset some of that. And of course, AI is a huge wild card in all of this. But the reality is like I said, I just flew back from Mexico City last night. They've been 4 and 5% inflation, and their savings rate is 2. So right now they have the almost the exact same issue. So if there's tariffs on China, then of course things that they do there are going to be less. I like what you put down here, Danille. You said 54% of all like household appliances, for example, in the U.S. are from China. Mm-hmm. So that might not seem like much, but that's a lot. And so you start to see, can we manufacture household appliances in the U.S.?
Well, there's always a ramp up period, like maybe we can, but there's always going to be a ramp up period. And also, there's a big cost increase because people are already upset over the cost increases of the last few years. I mean, my God, I just had to get a refrigerator for one of my rentals, and at a dent and ding place, it was $1,000.
Yeah,
that
used to be new, right?
Yeah, and that was at a dent and ding place. So so for me, I'm like, man, $1,000, now with a tariff or now manufactured here in the U.S., like how much am I going to have to pay for a new refrigerator? These little things add up to people and landlords.
It does. And I also think the other thing to watch is I also know manufacturers or entrepreneurs or companies or, they're looking to other countries. So if there's a, 100% tariff or 50% tariff or whatever the number is on China, maybe they move it to, Vietnam. Maybe they move it to Cambodia. Maybe they move it to Mexico, which we have that NAFTA agreement, the North America Free Trading. So there's lots of things, obviously, that are going on behind the scenes. And companies are trying to figure out, how do I stay in business? How do I keep my margins? How do I not pass on? I think that is always the first thing. You can't just pass on an increase on something that you've been selling for years to the consumer just overnight. So really who takes it in the chin is the company. So then the company has to decide, do I continue to do this? Are the margins even there? Can I pass this on? So all of that stuff's going on right now. And one of the strategies is to look at other countries.
Well, and I think one of the biggest things is going to be, new construction, right? So you have to look at the construction side of things. So we already have home builders right now getting squeezed because they're not able, they're doing a lot of concessions, they're pulling back, the market is not super strong for them right now. But if their building costs go up, they're going to have to either calculate that in and sell the home for more, like moving forward, or they're going to have to pull back and stop building altogether.
That's a really good point. So, we haven't even talked about this much. We did during the supply chain pandemic times, right? But right now, home affordability is actually a supply issue and an interest rate issue, right? So we know this. Obviously, you guys know this. And by the way, we are seeing more listings and we are seeing all kinds of stuff going on in that market, and that's actually trending. But the reality is nobody's really talking about how much does it cost to build a home today, right, from scratch. And I think that is something that everybody needs to think about is, excuse me. So that is going back to the appliances, right? The appliances, the lumber, which of course we know that we get a lot from, let's say, Canada, the concrete, the roofing tiles, also from Mexico, at least in Arizona. So there's a lot of things that are going on that contribute to the price. We're a general contractor, we're a builder. Right now, we're actually under construction on 312 units. So this is something that we're dealing with right now. The reason why our costs right now of construction are lower is there's only one. It's because there's not a lot of people building. Mm-hmm. So that's it, right? So as interest rates go down and as people build, what happens is if you're a drywall contractor and you're scrambling to keep your doors open, you're going to take whatever work you can. But the minute people start going again and you have lots of options, you start to build your profit into your price. That's just how business is. And so there was a time when it was booming a couple of years ago where they had their pick, like which subcontractors and which general contractors do I want to work with, which jobs do I want, and they would put these huge margins on there, and that is how the business is because you're scrambling at that point just to get those drywallers on your job, and so that's obviously regressed, and so that's a piece. And while I wouldn't necessarily call that inflationary as a result of tariffs, but it is a supply and demand issue that actually pushes prices up and also squeezes them back down. So we don't have that right now. So if you add low interest rates and you add higher tariffs that passes through on some of these things, on it in addition to the high prices, it actually could get a little bit worse.
Well, when you say low interest rates, you mean high interest rates?
Well, what I'm saying, though, is if low interest rates create more building, right, and people go out and get loans to build houses, build subdivisions, build apartments, build whatever, then what happens is those small subs, those contractors, those subcontractors, they have their choice. And now all of a sudden they start to ramp up and they start to pad their margins. That's what I'm saying.
But you're probably not going to have building if you have the Fed not lowering interest
Correct.
rates and you have high tariffs,
Right.
which are going to increase
Right.
building costs. Because
Right.
it's a supply and it's a demand. So you can only, if it's going to cost more to build a house and nobody wants to pay that price to build a new home, then they're not going to be doing it because they're only doing it if they can
Right.
sell it.
So we've just seen that, right?
Mm-hmm.
Like you guys, some of these big D.R. Horton, Pulte, Lennar, like those are public. So the beauty of that is you get to actually dig into their their earnings reports and stuff. And so hopefully you guys know that Lennar has been using massive rate buy downs and marketing costs and things like that to move some of their new product. And they're not the only ones, right? So why do they do that? They do that to be more competitive. So, but again, that goes back to the margin, right? So you think about what the price of something is. It's land plus construction. That's it. That's the number. So every developer has that number. What do they pay for the land, and what does it cost to build this house, whatever that house is? That's their basis. Anything over that is profit or margin. And so as you start to see these margins come down, which is reported in these quarterly earnings, then they start to pull back too.
Well, I think it's important to note that, your starter homes get hit the hardest on this kind of stuff because there's less profit in a starter home than there is in a more luxury, higher end home. So, these builders are really going to have to, they're already bare bones. Like, what more bare bones can you do, right? And so if builders aren't building, that's going to push people back to existing homes. Essentially.
Right. And that's not such a bad thing because, we are seeing a growing inventory, right, in that arena, right? And so historically, the existing housing stock, let's just say the common people that own stuff, have always competed against new home construction, always, right? And I also think the consumer always is looking for something new, right? And that will always be the case. The question is how's it priced? And then also, what's the cost to finance it? Mm-hmm. And so the home builder has the advantage of being able to buy down that rate, right, as part of their profit margin. That's what they use. It comes out in the form of a marketing expense, but the reality is it just comes straight off of their bottom line. That's all that is. And so you're right. what will happen is if we really want to see, and by the way, this is going to be temporary, but if we really want to see this work, then you need to have low cost construction. You need to have low cost price to finance, and you need to have a lot of supply, because supply is always going to bring down pricing. When there's a lot of something, whatever it is, for somebody to choose from, then that's when you start to see discounts. That's when you start to see better pricing, is when there's lots of choices for the consumer. That is the number one thing that's going to drive this down. The problem is back to the original conversation here, the tariffs, as they make their way, depending on what we get from, let's say, China, because that's just the most recent article. But tariffs have been on the table for a while, and we don't get everything from China either, right? We use a lot of places to import goods, and so does every other country, right?
Yeah, I mean, but I do think, though, when you're looking at homes, so, I had this with one of my clients just this week, is she was looking at making an offer on a home that needed a bunch of work done because it was cheaper. And then we were looking at homes that were fully ready. And after she got this work quoted, she realized how much cheaper it is right now, typically, to buy a home that is fully redone, because the cost of labor and supplies are so much more.
Yep.
And this is definitely going to get worse if these tariffs are implemented. And so I think, as a seller or as a home buyer, you should know that if you're going to be listing your house, like, it's going to sell faster if it's fully done. It's always kind of been the case because people, like a fully done home, but now it's really a monetary, it makes more sense a lot of times to buy a home that's already been done.
Well, okay, so now let's take a look at, replacement cost versus brand new, right? And I think this is something that you always got to watch. So as you guys probably know, we've been buying properties. We're in escrow right now on one in Las Vegas, 206 units, that was built just a couple of years ago, and it's fully occupied, stabilized. And we're buying it below replacement cost. So there's all kinds of reasons for that. But so the question would be, would you break ground on something next door? The answer would be no, because when things are selling below replacement cost, then you obviously would not be building right now, right? Now, different markets obviously are responding at different pricing, and so it doesn't mean that you can't build, but what it means is in some markets, if you can buy below replacement cost, you will. And so that's also the same thing that is happening to existing housing stock. So if you've got something that you've been, it's 20 years dated inside, 20, 30 years dated inside, when people walk into it, they know some people will just buy it as is, of course, but some people are going to want to renovate, and they're going to want to update things. And so then they're going to have to look at these kinds of things, as kind of to Danille's point. So in some cases, when you're looking at, do I buy existing or do I buy something that's been renovated or new, they're calculating that, and it's not too difficult to do. And so it's just less of a pain in the butt to be able to buy something that's refreshed, and somebody's already taken that hit financially, and it just lowers the degree of uncertainty, right?
Yep. So let's jump into the bond market.
Yeah, but the bond market, I think, is like, a lot of people don't understand the bond market. I'm going to talk about this. And why I think that this is actually one of the bigger issues to watch is because the bond market responds to inflation. I'm going to get into that right after our commercial here from our sponsor, Monetary Metals. Gold is near all-time highs, but appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate, but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control, and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit Monetary affordability-metals.com/Ken to learn more. Leasing gold involves risk and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more. All right, so now let's get into bonds. So here's the deal. If the bond market anticipates that inflation is going to go up, then we have an adjustment with the bond yield. So that's basically how that works. And let's talk about what a bond is. The bond is essentially a loan. Now, it can be a corporate bond, it can be a municipal bond. So it's essentially a loan, fixed rate loan with a fixed term. So for municipal, it might be for infrastructure, roads, or something like that, right? So the government issues these. That's a municipal. Or it could be a government, which is basically, or it could be corporate, which was the government, or corporate raising capital. Okay, so here's how it works. If you bought a 10-year bond at 3% rate, let's say, and you're happy you're getting 10 years on that bond. Now bond rates go up to 5%. And by the way, bond rates are basically operate to the inverse of interest rates. So if interest rates go up, let's say, as a result of inflation, so now that bond rate is a 10-year bond at 5%. Now the bond that you actually have is less attractive than one at 5% because it's more. So therefore, the bond rate, the bond yield decreases. So that's how that works. The bond prices decrease. So that's how that works, and it can be a little complicated, but it's really important because here's how it works, guys. If let's say you go buy a home, and you buy that home, and you're good, and the rate is 6%, and now the mortgage company packages all those up in what's called mortgage. It's called the MBS. What is it? Mortgage bonds. Jesus, right? Mortgage-backed securities. That's right. I forgot bond on my head. Mortgage-backed securities. Okay, MBS. Okay, that's called securitization. They're taking all these mortgages and they're packaging them up and they're selling them as bonds to investors. So that's how that works. So your mortgage goes into a mortgage-backed security and then it gets sold. And so that becomes a bond, all right? And so that's why this market affects mortgage pricing. So that's why this is so important. So an potential inflation actually does affect bond prices, which does affect, of course, mortgage prices. So this is why this is important to watch, is if tariffs actually do create higher inflation, then it's going to affect the mortgage market, which is going to affect the loans. And I think that no matter what if a home price is $400,000 and your rate is 6%, and all of a sudden you've got this inflation issue and you've got this pressure on the prices of these bonds, then what you're going to have potentially interest rates potentially could rise as a result of this.
Do you think, though, that there's room for like some QE? Because Trump does not want interest rates going up.
I know. Of course.
And so all he can, the Fed can cut rates, but to your point, it's the bond market that really sets the rate. But could he implement some kind of QE or whatever they call QE light to try and, offset the interest rates? Because he's going to want to do something.
Right. Right. I think, yes. I think the big thing to watch is if inflation potentially is kind of the match for the fuse of all of this, right? And then he's going to have, in my opinion, you're going to have issues around what to do with interest rates. So, and of course, that affects consumption of every sort, autos, electronics, housing. And then, of course, you're going to start to see these other kinds of mechanisms that they're going to use, like the 40-year potentially.
Yeah, but they do need to get these interest rates down. That's one of his big things. So, I think that it's important to note. I'm very interested to see at the end of October, in a couple of weeks here, when Powell and the Fed meet, what they decide to do. Because I think in their calculation, they were going to continue to lower rates a quarter point, but they might put a pause on it. And I think that what they decide to do will very clearly show whether they're going to focus on inflation or the job market. Because the job market's not in a good position right now either, and these tariffs are not helping that.
Right, at least right now. That is for sure. So I think, if I do believe that you're going to see a quarter coming from between now and the end of the year. So I do, and we all know that there's a lag that makes its way into the economy. And we don't know exactly whether these tariffs, are going to really ripple through. There's a lot of factors here. The one thing, though, I think is clear is, China, if this happens, we're the biggest consumer in the world, and we consume a lot of Chinese imports, period. That's just a fact. So that will make its way, but I don't think it's going to make its way into next year. And this is, kind of why I'm really bullish on buying right now, because real estate in a lot of ways is getting beat up. These crash bros, these YouTube crash, whatever you want to call them. It's interesting to me, they're doing that because it's actually a little bit of a benefit, to me when they're signaling that. It's like it's a great time to buy. Like you buy when things are disruptive. You don't buy when things are going great. That's the epiphany that these youngsters don't get. Is when there's blood in the streets, when banks are taking back commercial real estate projects, when rates are up, when expenses are up and cap rates are up, and it's hard. That's actually the best time to buy, because what you have is the people that didn't capitalize well, didn't operate well, their occupancies are, they suck, they bought in bad locations, they overpaid, or whatever the story is, it doesn't really matter. Now's the time to go in and clean up those messes. And that's precisely what we're doing. And the exact same issue with this new construction. So why would we be buying new construction right now? Well, you think about it. If rates went up, and so people have new construction, the rates are 8-9%. That's really expensive. Plus, there's a personal guarantee associated with that. So the developer, they're on the hook for these really, really high interest rates on construction debt. So, and the reason is because it's riskier than regular debt, because when you're building, there's no property. It's basically nothing. It's land, and so it's priced accurately. It's more expensive. So when you get stabilized, when it's done, a lot of the risk is gone, and then you put new debt on. Well, so catching a developer at the tail end of a construction loan and trying to lease up is the greatest opportunity for somebody who's trying to buy that, because now I'm buying something, and they're getting deep discounts, and so there's a strategy behind all this. So interest rates, even though they're high, and cap rates are high, and expenses are high, and these doom and gloom YouTubers are saying, yeah, everything's falling apart. That is precisely because I made the most money ever after the great financial crisis in 2008, 9, 10, 11, and 12, when the banks were licking their wounds and they're taking back all these assets. That is the time. Now, you don't want to catch a falling knife either, but you do have to pay attention to when there's disruption, there's blood in the streets, banks are taking back these projects, and the syndicators are licking their wounds, they're running out of money, they're trying to find new rescue capital, all that stuff's happening. The professionals are sitting on the sidelines, just lining the coffers, ready to go. And that's kind of where we are. I
think you're being a little confusing there, because you're talking about the multifamily market. That is not where we are with the single family. So I think you need to clarify that.
Well, yeah. But you're right. Real estate's a huge category. So I'm not specifically talking about a custom home, or a neighborhood. But it is a huge piece. Real estate across all sectors is down.
Yeah, but when you're saying like the banks are taking homes back, like, when you say that, I think that people then assume I should wait till the bank starts taking homes back. And I just don't think that's great advice, because the banks aren't taking single family homes back.
I said that banks are taking homes back. I said
Okay.
that there's bank defaults. There's for sure. I mean, we're dealing with them every day. And, I don't do single family at all, guys. Like, that's just not my world at all. So, of course it's going to be different.
Yeah, I just want to clarify.
So why don't you clarify on the single family, and I'll stay in my lane.
I just think that when people listen to you, they're
best.
like,
Come on, girl, let's step up. What's going on with single families?
Well, single family, we're really not seeing, it's not really down that much. We're seeing movement in the market for the past 2 months, and we're not really seeing a lot of home price declines in Phoenix, in the area I'm in. I can't speak nationally, but I know that like the Northeast is doing really well. I know that Florida and Texas are having some issues, but at the end of the day, everyone's in a 2 to 4% interest rate, and we're not having much distress on the seller side. We're seeing sellers, if they don't get the price they want, maybe they'll reduce it a little, or they'll just delist it. We're not seeing a lot of major drops in prices unless it's a flipper or somebody that needs to sell immediately for some kind of reason. But for the most part, things are still going off the shelf. I went to go show a client a house the other day that had been listed for 2 days, and now it's under, 2 of the 7 homes we wanted to go see are under contract. So, I'm just saying people kind of hang on what you say. So when you say that there's blood in the streets and there's all this stuff,
sure,
they
fair.
take that,
guys, like, obviously the word real estate means lots of stuff. And for me, I can tell you this for sure. The multifamily arena is, the values are down 20, 30, 40%, sometimes even more. That is a fact. Why is that? That's because interest rates went up and cap rates went up. And if you guys know multifamily real estate, investment real estate, I'm talking about investment real estate. Danille's talking about somebody who wants to buy a home and move into it, right?
No, or an investor that has single family.
But also how it cash flows, right? Mm-hmm. So, we're in different arenas. That's all. But in my world, there's blood in the streets for sure.
Mm-hmm. Yeah. And the difference is, in your world, a lot of people didn't fix their interest rates because they were doing renovations. And then in my world, most people have a fixed low rate.
Yeah. But yes, but I will tell you this, like, raising money from investors, it affects them. So if there were LPs or investors that invested in some of these deals, the equity's not there. Simple, right? And so like this developer, like the one I'm buying right now, we're buying at below replacement cost, not much above the loan. So that means that wherever the equity came from doesn't really matter. It really, literally doesn't matter. Probably came from a pension or a life company or who knows. That money's gone. Like, literally, it's gone, because you're basically, the developer's just trying to pay off their construction loan. So you've got equity and you have debt. So on my world, we're trying to buy. We passed on a deal the other day in Arizona, actually, where the property wasn't worth the debt. So we passed. This is what's going on in my world. So, maybe not necessarily in the single family side, but it's a very different world over there. So that's why we have Danille on.
So we have a question from Matt, and I think it's a good one. It says, Ken and Danille, what are your thoughts on people who are investing into renovations with lines of credit right now to refinance soon?
Good question. Really, really insightful question. So there's a bunch of factors here, but let me break it down. So this is basically a flip, right? So the price of the home plus the cost of the renovations plus the cost of the financing, that's your number. So if that's positive, then it's good. If it's negative, it's not good. So let me walk you through. I know personally that some of these companies that were, I guess they were 10, 12, 13, 14, 15% money. So the person that's buying the home and doing the renovation, they price that in. But they price it in on an extremely short-term basis. So they say, I'm going to buy a home in, let's say, October, and I'm going to be completely out of it by January or February, right? So they anticipate that this money's only going to be out 3 or 4 or 5 months. The issue is time. So, and of course the cost. So, and then that eats away at your profit. So if you're able to turn that house in 3 months, you're probably going to be fine. You probably built that in. But if it takes 6, now you're eating into the profit. If it takes 9, now you're really seriously eating into the profit. And that's when you start to see the discounts. So it just, so those are the factors, and it just completely depends on how many days on the market. And that is growing right now, as we know.
Yeah, and it is risky. We just saw like one of the houses that we were looking at, just actually went to auction, and it was a flipper, and kind of same thing, right? It had been sitting, the price had been lowered. I think then they listed it to break even, and it still didn't sell. So now, it's going to auction. So there is risk to that right now, especially because
Wait a second. Are you telling me that there's risk in single family now?
There is for flippers.
What just happened?
I did say for
what
flippers.
What just happened here?
Yeah, because they have to sell it,
Yeah, that look. I'm in trouble later, guys. No, but this is my point, right? Mm-hmm. So, that's a speculator, right? It's an insightful question, a great question. And so you're not going to have that in the person that owns a home, right? You're not going to have that. But the person who buys it and then tries to time it, they're the ones in trouble. Because don't forget, the big issue is exit and time, right? Like you could do stuff. Like on the multifamily side, we had the exact same problem. People said, I'm going to buy this 200-unit project. I'm going to renovate it in year 1. I'm going to have this floating debt on it, and I'm going to be out of it in the second year. Well, that just didn't happen, right? Because rates went up, and of course now rents are soft based on over 500,000 new units being added in the U.S. this year. So all of these things have play into this, but this is where experience comes in, right? And so in the scenario where Danille, the very unique scenario of the the one single family house that actually apparently went back to the bank, I would go in and just crush that, right? Because then I would go in and I would offer a deep discount for a renovated house, and the bank doesn't want these back, right? And then so now there's a bidding war, and obviously, and I guarantee you, there's a process where this person bought it, renovated it. Time was not their friend. It eroded the profit for them. And then the person who did this, of course, they're scrambling, they're discounting, they're doing whatever they can, and it's going lower and lower and lower and lower. Don't forget all the stuff that goes on before it actually does even go back into default. There's a lot. There's months and months and months and months and months of stress and anxiety and price reductions and all that kind of stuff. But at the end of the day, the market decides. That's it. There's not a lot you could do. So what I always tell people is, stop, death of 1,000 cuts, right? Cut once, cut deep, and call it, right? And that's what we've had to do that. You just got to go really, really low and let the market come in and save your butt, and then move on and call it a day, even if you're writing a check, right? And that is the way that's the other side of it. And that's what we're seeing now, is we're seeing the inexperienced deal with this now for the first time. So this is good. I mean, come on, just, as my dad would say, it's like, this makes you tough. So this is what we're seeing right now.
Yeah, and I want to get into some of our Ask Ken questions. So Dave said, I'm building a team to help me vet potential multifamily apartment buildings and communities. Can you advise on how early I can compensate these people and how to look for good recruits?
So this is a great question. I actually just had this question the other day from somebody else. So the reality is, Dave, thank you. It's a great question. Don't pay anyone, period. Everything's based on performance. So it should be commission-based. Do not believe that you need to build. You will have a gun to your head to try to cover your overhead, and you'll start to compromise on the fees that you're making, and you're going to start to close deals because you're going to have the stress of the overhead. You got to build your team right now with performance. So now think about this. So you close something, just pay a commission. You close a mortgage, commission. Close an acquisition, commission. Now you might not be able to do that from an assistant standpoint, but we're using VAs at out of the country for things. There's lots of ways to do this, so I would be very careful with if you build it, they will come type scenario, because we're heading into what I consider to be 26 is going to be one of the bigger years of disruption for multifamily. And I also think that we're going to see the institutions come back in, and the big money come back in. And we're already seeing it a little bit. And so this window's, I guess it's still open, but it's maybe half closed. And so what does that mean? What that means is there's going to be managed money, there's going to be funds, there's going to be people that are setting things up right now. There's not a day that goes by that I don't see something where somebody's putting together some kind of fund to take advantage of distressed real estate. And again, this is the tale of two worlds going on, as to Danille's point. I mean, we are not seeing this huge implosion like we saw in 2008, which I went through, for the single-family market. But Bank of America, let's just pick on them real quick. They are, or Wells Fargo, they have loans in the multifamily arena, in the office arena, and in the single-family arena. So if you're a bank, you don't care. You're, a default is a default is a default. So whether it's an individual or a syndication or an office building or a multifamily or a retail or a condo project or a custom home, they don't care. It's a different division, but the reality is it still affects the bank, still affects the lender. And so, that's what we're starting to see right now.
We have a great question from Josh on YouTube. He said, do you think with multifamily rent softening, it will pull more demand for single family home purchases? If so, how do you think that will affect single family pricing?
Yeah, that's a good question. So now, I don't want to assume, Josh, that you're thinking the single family home purchase is for investment. If you are, then the answer is yes. If it's, but a lot of, don't forget, there's a tremendous amount of single family. I mean, single family used to be, when I was a kid, nobody thought about buying them as investments, right? They were, people would buy them to move into them. So that market is kind of new. You have Wall Street now seriously involved, which I know is, a lot of people aren't happy with, right? But the answer to your question is yes. We're going to have, there is disruption. There's definitely rent softness for sure. I'm telling my entire company, so we get, let's call it 10,000 units. No rent growth next year, guys. Like, seriously, you cannot project rent growth. Okay, so, and in some cases, you might even have concessions. So not only is there no rent growth, but you might even have concessions, which means that our income for 25 could be higher than 26, potentially, based on what's going on in the market. Now, why is that important? It's important because I can assure you that expenses are going down. So what this means is that 26 could be a harder year than 25 from a multifamily operations standpoint. And that is the right way to underwrite things, and that is the right way to look at it. So now, what that will do is it'll make a better case from a renter standpoint to, it'll make it harder because now the renter is going to get a better deal. Like I walked you guys through, we have an area in Phoenix downtown where it's 4 months free on a 12-month lease. So imagine if you're a renter, and you're in a place and you're paying $1,500 a month, let's say, down the street in something that's 20 years old. And you will stroll into a Class A building with an elevator, all the brand new amenities and bells and whistles, and the rent's $2,500, let's say, but you get 4 months free. Okay, well, it's $10,000. Like $10,000, on a 12-month lease. That's, so just spread that over. That, all of a sudden you're pretty darn close to, what you have right now. So that is for sure going to affect the single-family home rental market, for sure, right? Because these Class A deals, they're going to have to get absorbed. And now, of course, if people want a garage and they have a family and they need a yard and they want their own pool and they want their privacy and they want somebody above them, next to them, down below them, and all that stuff, then I get it. But if in the social capacity, If somebody has a home and they're like, I like the lock and leave scenario, I'm going to go over here because they're going to start to look at the pricing. So yes, I do think there'll be a little bit of softness. It'll definitely pour over to the home, the single family home.
Yeah, one always bleeds into the other because you can't have multifamily at a discount and then such a gap between the single family. Renters aren't going to pay that. So, it's hit all of us.
Yeah, for sure. Yeah. So it's a really, really insightful question. And by the way, guys, this is going to be all of next year. So just strap on and just know that it's going to be a tough year, right? And we're preparing our company. We're trying to figure out what can we cut because the market is going to tell you what the rent is, and it's going to have to absorb all this new product.
Well, and then you throw tariffs in, and so every time an appliance breaks or every time you need to repair something, it's going to be more expensive. Yep. That's going to hit you too.
Yeah, 100%.
Tammy from Ken Pro is asking, what areas of a rental should I focus on to increase the rents? The kitchens, the bedrooms, the bathrooms, etc.
Yeah. If I were to rate them, I would go kitchen 1, bathroom 2, bedroom 3. Now, that's a real general, but I think that you can do things pretty reasonably. So we do spray-on countertops, believe it or not. So you don't have to do the brand new countertops. The spray-on countertops you can do for $100, $150 a unit. And then, of course, paint is not that expensive. And you can do the scratch and dent stuff with Danille. And by the way, when she says that, these things are brand new. And they have a little dent on the side, next to the cabinet. You can't even see it. So it's still brand new. But, so there are ways to do this. And flooring and lighting can be a little more expensive. But at the end of the day, you can actually upgrade a kitchen for darn reasonably, you can do it for just a few grand. So now that might be a lot. So, but I'm just saying that for sure, when people walk in, you got an old fridge, old sink, old cabinets, those kinds of things, old countertops. It does make a difference in the overall appeal.
So I do have a question, though. So do you really think it's a great time to renovate right now, though? Because rents are kind of down. I know I have some units that aren't.
Question. Yeah. I'll tell you our philosophy. So at one time, I had $68 million of renovations going at one time over multiple projects. Now, this is going back over 2 years ago. But I pulled the plug. Ross and I said, listen, we should pull back from renovations. Why would I do that? Because I said, let's offer the consumer what we call a classic. Classic means, something that has 20 years dated inside, and then you got to renovate it. So if you have a one-bedroom price that's a classic, and you have a one-bedroom price that's renovated, you're going to get two different kinds of rents. And it's really an affordability play, right? So kind of back to Danille's point. There's a time where when there's a lot of competition, that you might have to actually do a little bit of renovation to attract a tenant. But there's also a time where you might want to have two different price points for something, and you might not get the money out of it. So, how do we check on that? What we do is we say, if we're going to renovate the kitchen, are we going to get more rent? And the answer might be no. Okay, but in a super competitive environment, if we have a renovated kitchen, maybe we're going to have higher occupancy. So that's the other piece you got to look at, because when people are looking at 3 or 4 or 5 choices and all being the same, and maybe yours is just a little bit nicer. So you got to consider all that. So sometimes you actually renovate to attract occupancy, and I think we're heading into that time right now. Certainly if you have these Class B properties, right? So imagine what a Class B property right now is dealing with, like on that example I just made. Like, there's no possible way that they can compete with 9-10 foot ceilings, brand new appliances, garage, elevators and all that stuff, when something's been built, let's say in the 90s or early 2000s. So all of that, but you just got to lick your wounds and ride through it. And so you don't want to renovate during that time either, right? Because that's not going to help you. So it is a extremely good question. So it's hard I don't know the answer on that particular one, but those are all the things that I would consider before I moved forward.
Awesome. Well, it'll be interesting to see what the Fed does at the end of October, and we will see you guys next week. Make sure to check out our podcast this Thursday.
All right. So see you guys.